It's a pleasure to have with us Amit, Wadhwaney, the portfolio manager of Third Avenue International Value Fund. Welcome.
Thank you. Thank you very much.
Amit, before we begin, I'd also like to thank Chris Swasbrook of Elevation Capital for making this conversation possible.
Absolutely, and so should I. Thank Chris as well. Thank you, Chris.
Amit, before we get into the investment approach of Third Avenue and how we can all learn from Marty Whitman and what wisdom he has shared over time with us, it would be great to hear a little bit about your background and how you got interested in investing.
Well, there was a succession of coincidences, an interesting sort of succession of curiosities which got me to this. Years ago, I studied engineering and mathematics. I stumbled into economics, a subject I actually thoroughly detested. Of course, if you get at all interested in economics, you're often interested in pricing and how things are worth and what they're valued at, how prices develop in markets. That was sort of one part of it. While studying for economics, I wound up getting Marty's book. Completely by accident, encountered a review of the book, Marty's first book, The Aggressive Conservative Investor. I promise you it's a terrifically turgid read, but it's probably one of the most informative and I think one of the most thought-provoking books about investing that I've read over the years. It was my first books. It's a very tough slog if you don't know much accounting, which I did not at that time. And nonetheless, it was intuitively obvious, it's very engaging, and I thought that was the beginning of something. I went to business school after that, and of course, business school was completely the opposite. It was an efficient market school, one of those schools where they teach you that everything that's known is embedded in stock prices, which is diametrically opposed to this book. Returning from the business school, I reread the book, and I thought I was pretty well hooked at that point. It's intuitively a totally reasonable area, totally reasonable way of thinking and approaching investing, and over time, I suppose, this interest deepened. Again, I can't say I know lots about other kinds of investing, because what's been of interest to me is value investing in various of its incarnations, various versions and types and different ways in which it's done. But value investing is something that's obviously very engaging, and it sort of started probably in 1979, and I had the option to come work with Marty Whitman, and that was an even bigger part of the learning experience.
So tell us a bit about that experience, and how did working with Marty Whitman influence you? What are some of the key takeaways and learnings from one of the investment greats, Marty Whitman?
Well, Marty is very, very focused on value investing, but value investing in his own way. Now, what is value investing as per Marty, as per Third Avenue? What is it? It really is a focus on a few things, a few very, very important things. One, of course, is intense risk aversion. The other is valuation, buying things cheaply. Again, that's at the core of what we call our safe and cheap approach to buying businesses or assets at a meaningful discount of what they'd be worth to another cash purchaser in a non-hype, non-distressed transaction. There's a few things about this approach to value investing which puts us at one end of the spectrum of value investors. Now again, value investing is a very broad term. It's gotten broader over the years. There's a great diversity of practitioners in this. And value investing as practiced here at Third Avenue revolves around a few things. First, we're bottom-up investors. Bottom-up investors tend to be focused really very much on the business or assets that they're buying and the securities that they're purchasing. This is not to say that we are oblivious to things macro. We're obviously intensely aware of macro, and particularly in our case, in my case, where we focus really in a great way on companies outside the United States across a wide variety of geographies and political regimes and governance regimes. You obviously have to worry about things which affect the company from the outside. So while we don't do lots of forecasting and we don't use macro forecasting as a basis of investing, we will if we suspect or we discern a company's vulnerability to adverse macro developments. We will almost certainly not buy it. So certainly we are very much bottom-up investors, very opportunistic, trying to buy businesses cheaply. Now, a byproduct of this is your selection process will result in a collection of securities which bears no resemblance to any index whatsoever. So a portfolio selected in this manner is quite unusual relative to a conventional traditional portfolio. The second aspect about this is conservatism that I alluded to. Conservatism in valuing a business. Now, there are obviously different valuation techniques that are used by different investors. Some people are great fans of the discounted cash flow approach. Others will project earnings and earnings multiples. We don't do much of that. I mean, look, we focus on what we know, the here and now, which is, of course, given our myopia about things macro, about absence of forecasting things macro, what do we know about a business here and now? What we know is a snapshot of the business as given to us by its balance sheet. We take the balance sheet and parse it, split it up into its component parts. The left-hand side, which is the asset side, we will value the individual components as conservatively as possible. So, if you're thinking about a business today and had to close down the business today and sell off the pieces today, what would it be worth? What would it be worth if the business just closed its doors? So I'm not paying for a rosy future or a future for that matter. So our valuations of the assets typically tend to veer towards the very conservative ones. Symmetrically, the liabilities, that's the right-hand side of the balance sheet, because most businesses come with liabilities. The liabilities that are sitting on the balance sheet. Then there are other liabilities that are sort of off the balance sheet, things that the company is committed to spend, the company is required to spend, needs to spend, just to stay continuing the business. So stuff that's known. And so going down the same line of reasoning, there are some recurrent spending items that occur for any company in its existence. I call them the general business liabilities, which are neither on or off the balance sheet. And that is this my big lump I call general business liability, just for continuing the business. Capitalize that and deduct that. So you're going to see a very large chunk of liabilities deducted from the assets, end of which you're going to see a very conservative net asset value. And what we try to do is buy at a discount to this net asset value. The reason for going down this path is it is robust in terms of being relatively limited in its use of forecasting the future. We're fairly modest in our ability to forecast the future, unlike other people. Many people have, of course, prescience, can see many years out, can pick the correct discount rate, can forecast inflation, and do all these things, these arithmetic things that produce numbers for them. We're not that clever. We're focused on the here and now, and what we see is what we do. Now again, this is not to say that we will not look for hidden values in assets. Visualize, for example, an asset. Think of this wonderful plot of land you may have between two big high-rises. And it's a little townhouse maybe sitting there, carried as a townhouse. Or for example, one actual example that we encountered a number of years ago, 5 years ago, was a parking lot, a terrible, decrepit, 6-story parking lot in one of our companies in Singapore had in the middle of a central business district. It was probably carried for $40–50 million. If you looked around it, it was surrounded by 60, 80-floor buildings. Now, this parking lot, could be repurposed and a building constructed in the place of the parking lot. The lot was not worth $40–50 million. It's probably worth a few $100 million. And that's, of course, ultimately what happened. But you have to think about your asset values not just conservatively and mechanically, but you also have to think of them creatively in terms of you have this asset, what could it be worth reasonably? A third characteristic, which is very, very important, it's not just a matter of cheapness. You could buy lots of cheap companies that wind up going bust. And that's obviously what we strive to avoid. What we're trying to do is buy businesses which have survivability, which have staying power. Staying power in the face of adverse developments, both at the level of a business and both stemming from environmental factors. Again, I hark back to a comment I made earlier in terms of adverse macroeconomic developments affecting a business. And a company should be able to stay the course, so that something that's cheap not only does not stay cheap forever, but it grows as a business and can make its way through adversity. So safety to us is really not the day-to-day stock price volatility or market risk, as people call it. People are very focused on that. That really is a distraction, because once you make the decision to invest in something, you are going to be taking on market risk. So that's a fact of life. So what is the risk that we are trying to avoid? We are trying to avoid the sort of risks which stem from anything that's internal or external to the company, resulting in the company losing value sharply, being permanently impaired, being not able to function as a business, or going bust. So it's really survivability of a business. That's what we're interested in. Again, factors internal to the company can be bad balance sheet, bad management, bad business model. This is the sort of stuff that saves you a lot of grief. It's the sort of stuff that you just mechanically can actually look at, think about, and avoid. You can save yourself a lot of grief. And two small other characteristics of what we do. As I mentioned before, we're very focused on balance sheets, most of the income statements, so that obviously guides us. And finally, we're long-term investors. Think in terms of investing in severely depressed securities for 3 to 5 years, and preferably a lot longer than that. And that's what we do. Now, the reason why we talk in terms of 3 to 5 years is because when you're buying things that are so out of favor, it sometimes takes time for the clouds to part and the sun to shine through. So, for example, factors depressing a company or a business or an industry need to work out over time for things to right themselves and valuations, sensible valuations, reassert themselves. So these are sort of 5 quick characteristics. Bottom up, very conservative valuations, avoid risk that can impair the value of your business, focus on balance sheets, focus on being a long-term investor. That's what we do here.
If we take this focus on the balance sheet and also some of the asset-heavy businesses that you tend to invest in. Now, asset-heavy businesses are seldom great businesses in the sense of a Coca-Cola. In a potentially inflationary period, could a focus on tangible assets rather than intangibles create some challenges?
Let me think back to some years earlier when I was growing up in the my first exposure to the world of investing and investments. I encountered Marty's book in 1979. That was a period of high inflation, pretty high inflation, the Volcker days. And inflation has really been coming down since 82, 83. Asset-heavy businesses, the thing about asset-heavy businesses is sometimes asset-heavy businesses can present tremendous barriers to entry. They could be constructed in periods when there's either some sort of bubble, witness, for example, fiber optic cables. Laying fiber optic cables was an artifact of the telecom bubble. The TMT bubble made doing stupid things like investing in fiber optic capacity very doable because people were willing to pay over the odds for what seemed to be negative net present value things, but just shoveling cash in this. So if you can get a company with fiber optic cables embedded in the ground today, this is something which is a very, very expensive thing to do now. And were inflation to rise further, were inflation to accelerate, it would be even more expensive. So the owner of such assets, given that there'd be very few or new or additional capacity being put in the ground, would benefit from that. Or yet another example is this fiber optic cable idea is not entirely abstract. When we own such a company in Poland, for example, which was a creature of the telecom bubble, whose original owners went bust because they leveraged up too much. And so what you got was you bought an asset which could cost $1.2 billion to put in the ground. Initially, we were paying about $300 million. And then during the 2008-9 crisis, we actually were paying an implied value of $200 million. It is currently, the market value is at about $700 million. We believe it's obviously going to be worth a lot more. Not because of inflation, but now it has a very large subscriber base. And to replicate that would cost much more than $1.2 billion. Or another
example, that's Netia.
Netia, that's Netia. It's this Polish company. Another example of an asset-heavy company is a company which was just taken over. Actually, the takeover is not finished yet. It should finish in about a month or so. Is a company called Viterra. Viterra is a Canadian agricultural grain handling company listed in Canada, but with a footprint both in Canada, Australia, New Zealand, and the Ukraine. Its big business was owning grain elevators. Grain elevators, of course, over time are fairly capital-intensive things to put in place. It's also sort of I'd call it oligopolistic business. Viterra, for example, handles in Canada, from Western Canada, Currently, about 46% of the shipments of grain that goes out from Western Canada, and now the deregulation is beginning to take hold in August. It's probably going to right in the mid-50s. This is a grain handling infrastructure which is expensive and difficult to replicate. And of course, as inflationary times come in, it gets even more so. Again, in Australia, they have a monopoly in South Australia and Victoria, which is more to my point. So it depends on the nature of the asset of the business. So for example, if you have a scarce asset, as in the case of NET, the fiber optic cables, in the case of Viterra, the grain handling network across the big grain producing provinces, as distinct from asset-like companies that own a slightly different scarce resource, intellectual property, the formula for Coke, for example. So there are different kinds of things that can do very, very well in periods of inflation. Sometimes resource companies do quite well as well, in addition. So there's a wide variety of things upon which the impact of inflation can happen.
With resource companies, thinking of oil and gas companies, investors sometimes look to those companies also as, in a way, protection from inflation.
Absolutely.
What about the reinvestment need?
Yes.
Isn't that a challenge for these companies in an inflationary environment?
Potentially. Let's take one example of a resource company which already has a reinvestment plan built in. Timber. Timber is a resource that grows, and of course, obviously, the reinvestment really is keeping your trees, fertilized, pesticide, with pesticides and herbicides, that sort of stuff. But in general, the reinvestment risk in, for example, something like a Weyerhaeuser, for example, is somewhat low, or someone that owns very large stands of trees. So, along that line of reasoning, for example, we do own Weyerhaeuser. We also own a Chilean company called Antar Chile, which controls a company called Copec, which is one of the largest private landowners in Chile, and they have very large plantation forests. In the case of oil and gas companies, now the question is, what are you buying? So, clearly oil is a depleted resource. There's no question about it. Over time, we preferred companies with massive resource bases that are untapped. So there is clearly a revaluation of assets in the resources in the ground. There's no question about it. But ideally, the ideal situation is one where there's only de minimis depletion on a year-by-year basis. So that's the sort of preference I have. Another area that's been of interest to us over the years has been agriculture in many, many different forms. I mean, as you mentioned, we spoke earlier, was an agricultural land company in Argentina, for example. Clearly, that's an interesting thing, although it's probably not time for it just yet. But other areas in agriculturally related businesses, Viterra was one of those things. Alas, Viterra is probably no longer for this world, so that's gone. But yes, inflation is something one does think about. One definitely thinks about. But yes, you're quite right. Reinvestment is an issue, but it depends on the nature of the business.
You seek to invest in financially sound companies that are cheaply priced. What are some of the reasons sound companies become cheap? And which ones do you embrace as an investor, and with which ones are you more careful?
So, there's a couple of things. There's actually a number of thoughts here. Financially sound is one of the slivers of a much broader aspect of being safe. When I talked about risk and risk aversion, the kind of risk that you avoid is not just financially unsound companies. That's one of a number of things. I mean, for example, you'd worry about the governance aspects, you worry about things like not just bad balance sheet, bad business models, bad industries. Sometimes you avoid bad industries. For example, a typical industry to avoid, from my part, is an industry with limited barriers to entry. Limited barriers to entry. So we buy companies which are depressed, where industries are depressed, companies are having difficulties. And we're very patient investors. We're happy owning these things for a long period of time, such that when times turn around, these companies do really well. Now, when I say really well, is they have a period where they earn, I'd say, supernormal profits. The problem with having a company which is depressed but in an industry where entry is easy, you will have very, very short periods with supernormal profits. which is one of the reasons that you will see a sort of bias. Yes, while we're value investors, yes, while we don't buy franchises, yes, while we don't buy the sort of obvious brands and moats, our companies do have some barriers to entry. So, that's an element of my safety, sort of the safety I seek. So financial soundness is one of those characteristics. So how do financially sound companies become cheap? Well, here's the thing. We are long-term investors. We're shamelessly long-term. And I have no qualms about dropping anchor with a view that I'm going to own this thing for 3 to 5 years. And my sort of approach to this and to my younger colleagues is that if this is not something I'm going to go to bed with every night for the next 5 years, I don't want to own it. It's just not worth it. So what that does, it raises the bar in terms of soundness across all these different parameters. Why do these things become cheaper? Well, sometimes people are very fixated on earnings. Earnings disappointed, ROEs drop, sometimes adverse things happen. This presents an opportunity to us. For example, just to give an example of a company that we used to own, we were a large shareholder, an Australian agricultural company, which Viterra actually wound up buying. The stupidest thing made it cheap. This company was a monopoly, kind of like Viterra, same business. In Southern Australia, it was a monopoly. And it was, as a monopoly, it was not a very clever monopoly. It was sort of a half-hearted monopoly. What's a half-hearted monopoly? It's a monopoly where you're the only supplier, and all you have to show for being a monopoly is only 3% of your assets. Now that's not very clever monopoly, right? So you could, I'm presuming you could start slowly, gradually tweaking it higher and higher, but they were very slow about that. So it was a very imperceptible improvement in the rate of return on capital. And so we reasoned, look, this is so cheap. This is so cheap as a monopoly. And what made it cheap as a monopoly, it was a very financially sound company, was that they had a bad year weather-wise. There was a drought in Australia. This, I think, probably goes back to the 2005-6 period, December 2005. And we got very busy in December 2005, early 2006. That was the Australian summer, bad harvests. The thing about this company is earnings were very linked to the amount of grain grown in southern Australia. Because of the bad harvest, because of the drought, there was a lower harvest. Therefore, less grain was handled. Less grain was handled, their revenues went down, their earnings went down, people freaked out, sold down the stock. And that's how we became the largest shareholder of the company. Now I know that sounds stupid, but that's the way it often works in reality. People are very focused on the here and now in a very narrow way and using earnings as the basis of valuation. What they were completely ignoring was this company had this amazing infrastructure all the way from gathering grain grown by the farmers, storing it, holding it, grading it, transporting it to the terminals of the ports where they had a monopoly yet again, and setting it on. So I could tell you when the rains were going to come, but I could tell you the stock was cheap. And the company had a good enough balance sheet to be a survivor. So people are often very focused on earnings. That's one thing. Another thing that causes financially solvent, financially strong companies to be cheap is sometimes, I hate to say this, because the industry I operate in is populated by some very bright, very diligent people. Sometimes people get lazy. Sometimes people are not really lock themselves up in a room for one day and sit down with pencil and paper, sort of add up the numbers. And that actually produces interesting values for us. Now, sometimes there's things that are sitting there glaringly obvious to us, and I wonder what caused people to miss this. Things that are large enough in terms of capitalization, therefore not obscure companies, things in developed markets which are very small and we focus on everything, like Singapore. Sometimes the structures in which these companies are embedded could be complex. People might not be willing to sort of do the work, the legwork, to sort of pull apart the structure, do the valuation very carefully, and do it. Sometimes it's diligence. There's a lot of stuff to do. People can be very distracted. People could also have very short time horizons. Hard to tell.
You distinguish between market risk and investment risk, seeking to take the former while limiting the latter. And you touched on some of that already. Could you give us an example that really highlights that?
Okay. Market risk is anytime you buy a stock, your stock could go up, down, up and down, and sideways. You are taking market risk. It's a fact of life. You don't like market risk, buy T-bills. It's as simple as that. Now, it's a fact of life, it's unavoidable. So what is it? What is the investment risk that I avoid? So market risk I coexist with. Well, what is this investment risk that I strive to avoid? Investment risk is what I would expose myself to in terms of adverse developments at the company that I buy because of factors internal or external to the business. Basically, it is anything internal or external to the company that could permanently damage the value of the business that you bought. It could be, the internal factors, very generic internal factors could be a poor balance sheet. Poor balance sheets expose you to a lot of risk. And anytime you buy a company with a poor balance sheet, you are effectively, de facto, taking on some very serious investment risk. What if the company cannot refinance? People have always assumed companies can refinance. Well, you have seen that happen again and again, yet again and again, where companies had difficulties refinancing and then go bust. Bad management, well, right there. People doing stupid things with your money is not something you want to do. They could be dishonest, they could be stupid, you want to have neither. So think about what these people have done over the many years in the past. Separate promotional management from sort of nose to the grindstone, serious, hardworking people. Third risk internal to a company can be a bad business model. Let me give you an example of a bad business model, avoiding which has kept us out of so much trouble over the years. It's a model about, when companies, because of their business, have to access capital markets or financial institutions again and again to keep their business moving forward. I'm not talking about companies that need to access capital markets in order to grow the business, to make an acquisition, but ones that need to, for recurrent business needs, go to capital markets again and again. Now, examples of companies like that, which we obviously avoided, because it's a business model I'm very, very wary of, is businesses like the investment banks that had big capital markets operations. Witness Lehman Brothers, witness Bear Stearns. Both of them needed credit rating. Credit rating agencies one morning freak out. That's the end of those businesses. That's not the kind of business I want to own. Obviously, that's an imperfect means of eliminating businesses because this blunt instrument of eliminating a kind of business also eliminates the Goldman Sachs and the Morgan Stanleys, which have so far been very successful companies and still surviving companies. So there are some business models I'm very wary of. What about external factors? Factors external to a business that we are wary about, obviously, in businesses, industries are very sensitive to government meddling. Now, government meddling is a wild card. You never know what that is. And anytime you invest in certain countries, you are probably taking on more business risk, more sort of government risk, regulatory risk than others. Investing in Russia comes with its own sort of issues. Although let's not take it out on Russia. Let's take it out on other countries like New Zealand, for example. Innocent New Zealand with the cleanest corporate governments, one of the cleanest governments in the world. Well, an example there was some years ago. We used to own a company called Telecom Corp of New Zealand. Fine company. Bought it because we believed that its competitors would die, which is exactly what happened. It turned into a duopoly in the fixed line business, a duopoly in the wireless business. Company was doing brilliantly, lots of excess cash, until, of course, the incumbent government in power, Helen Crook's government, let's name names here, decided, and she was very unpopular. She decided, well, one of the ways I'm going to get my popularity back is let's beat up on Telecom Corp of New Zealand. The shareholders are foreigners. They don't vote in New Zealand. Let's break up Telecom Corp of New Zealand, and let us also make sure that New Zealand Telecom winds up giving farmers broadband access at the same rate they give people access in large major sectors. Obviously, utterly non-profit, in a highly unprofitable venture, but supposedly very popular. She thought it was going to be very popular. Now, imagine the impact of that on a company like Telecom Corp of New Zealand. So the business purpose was being bent to suit political ends. That does not work for people like us. As that news began to break, we sold. It was a profitable investment. And we, thank God, never had to look back at that. Of course, she was not re-elected. Her policy was so ridiculous in any event. But that's an example of a government policy change that can really blindside. Handicapping governments is not easy. Some governments is easier. Argentina, for example, is a very easy thing. Yeah, or for example, another sort of external risk that we worry about a lot is, and I alluded to that, is industry structure risk. There's some industries I don't want to invest in. Industries which have, as I said, ease of entry, for example. Industries which have unusual competitive characteristics. Why bother? There's probably easier ways to make money. So.
Now, you manage an international fund at Third Avenue. How does your approach to international investing differ, if at all, from that to investing in the US, as you have funds investing in the US as well?
Sure. Now, in the old days, people used to think the US was a sort of risk-free market. You didn't have to worry about things like political risk. Well, one thing you don't have to worry about is exchange rate risk. If you value things in US dollars, well, you're going to be in US dollars here. There's a number of things. First and foremost, US investors have been spoon-fed lots of information over the years. Spoon-fed in the sense that there's a lot of information that's mandated and regulated to be disclosed. And that happens in the US. It's somewhat less than that outside the US. When I started investing professionally outside the US, that really goes back to the mid-1990s, there was a lot less disclosure available outside. You'd obviously invest in businesses you understand, where disclosure was adequate. But what you do, one of the things you tend to do, is not just rely upon mandated disclosure. You do a lot more digging, a lot more legwork, a lot more kicking the tires. You develop a lot more know-who. There's a lot of other sources of information. In the US, most investors very often just content themselves with the 10Qs, 10Ks, and that sort of stuff, the proxies and so forth. Well, you have much of that in countries like Canada. I mean, that is also sort of available outside more and more and more and more. It is available. So that has changed. The other differences, and there are many, I mean, in terms of takeover codes, for example, in some ways I find the takeover codes much more conducive in other parts of the world. In various Anglo-Saxon countries, for example, you can block hostile takeovers, you can block takeovers that, or take-unders with a 10% holding. And we have done that in the past successfully to good end. And so you have to be cognizant of the regulatory environment. The other thing, again, going back to disclosure, is the opacity. Depending on the nature of the company you own and the country you own it, it could be controlled by other entities. So you obviously have to worry about things like related party dealings. Sometimes asset-rich companies attract not such nice people. And that is obviously something we are totally paranoid about. To be quite candid about it, you worry about who is going to take money out of your pocket, because we focus on companies with big balance sheets, very liquid balance sheets, often flush with cash. And if, for example, the parent of this company is a highly leveraged company, the highly leveraged company might want to dip its hands into your pocket to extract that cash. So related party dealing sometimes might be easier in other countries. So you approach that with a level of paranoia. But again, this could be, this is true in the US as well. I mean, in issuance of securities to related parties, but the reporting requirements are bigger and better in the US and greater frequency. But you do much the same sort of stuff. I mean, you approach things with a greater layer of concern. For example, in foreign countries, one of the factors that has sunk many investors over the years has been the idea of currency mismatches. I think people don't focus on it that much. For example, in other countries, I mean, it's true in the US as well, but in other countries, much more so, in a given company, revenue streams and costs could be different currencies. Assets and liabilities are different currencies. So that is particularly bad if your company has a leveraged balance sheet. For example, over the years, let's name a few of these wonderful crises that have been great opportunities. The tequila crisis in the mid-1990s. You had the Asian crisis in 1998. You had Argentina blowing up in 2001. A common thread that ran through these things was, for a very different sort of origins, was that the currency financial institutions had their liabilities denominated in, very often US dollars, was different from the currency in which their assets were. So, a repricing of assets caused by devaluation or unpegging, you had a massive asset liability mismatch, and the banks blew up. But that's not, banks are sort of a particular example because they're highly leveraged capital structures. And of course, this is where currency mismatch is at its most acute in terms of its impact. But corporates similarly can blow up and have blown up. So I mean, there's that. Now, another aspect about foreign markets versus US markets, and again, this depends upon the history. In many developed countries, before capital markets are really developed, you're typically used to have a company highly cash generative, which is a source of capital for another company. That's how you develop what they call group structures, or in Korea they call them chaebols, for example. So the thing about these things is you could have these octopus-like structures. You could have a lot of opacity in related party dealings. You could have a lot of currency. You could have a lot of bad stuff going on. I mean, this is something that South Korea in particular, found out in a very, very, very big way during the Asian crisis in 1998, which is one of the reasons why the rules related to chaebols have been completely revised so as to sort of diminish systemic risk in South Korean companies, the chaebols in particular. So there is that aspect to there are risks peculiar to each market. So it's hard to sort of generalize across markets. I mean, I will make an outrageous statement such as we had 2 years ago, in the very early years of the first fund I was managing, which continues to this very day, had to take recourse to the Sri Lankan SEC about some mischief that was going on. And they responded faster than you could ever imagine, the Japanese SEC responding. So it is not a matter of development or degree of development or size of capital market. It's very much on a market-by-market basis. Hard to generalize.
Well, would you perhaps single out some of the markets that are more transparent, if we take Asia, or what are some of the role models perhaps for some other countries to aspire to when it comes to regulating a financial market in a sense that's conducive to foreign capital and wealth creation over the long term? Who gets it? Hong Kong, Singapore?
Well, funny thing is, in 1996, I wrote a piece about this, about emerging markets, that they would inexorably, because of their growth needs, therefore the capital needs, would have to become more transparent, would have to improve the regulatory environment, so as to attract foreign capital. So, where are we now? Well, many of these markets have actually leapt over and done that, have actually leapt over, in fact. It's not just the markets doing it, but individual companies themselves doing it, improving the level of disclosure themselves such that they could, even within the context of their own market, attract foreign shareholders to buy their shares in those markets. Separate and distinct from the markets themselves. Okay, now, in terms of Singapore and Hong Kong, they're not bad. Are they the most transparent? Reasonably, but not quite. I mean, Singapore's quarterly reporting. Hong Kong still does not have quarterly reporting. In terms of markets themselves, it's a company-by-company thing. In terms of actual markets being watchful, I mean, Singapore will get very high marks in terms of actually being very watchful. Actually, little New Zealand and little Norway might as well get. It really will vary by market. It totally varies by market. I mean, some markets make exceptions. France. Well, for French companies, sometimes exceptions happen. I mean, clearly are markets at the other end of the spectrum in countries like Europe, which have always been a very sort of iffy, edgy place to invest in. Italy, for example. We made our very first Italian investment after much humming and hawing in November 2010, which worked out very, very well. But it took a lot of agonizing and worrying about what could go wrong. We did not, in that case, depend upon the market regulator to be particularly protective of us. We expected a limited degree of protection. So, I mean, it would really vary. Anglo-Saxon countries historically have been better in some ways. And I'm not talking of quality financial reporting per se, but in terms of regulatory oversight. It really varies. I mean, This is as distinct from accounting principles. I mean, continental European companies in some ways can have much more conservative accounting than, say, the UK, for example, which is a little bit more go-go accounting, so I'd say. On the other hand, the regulators in the UK would snap to attention much faster in many cases than some of the continental ones. So generalizations are very hard. Company-specific situations will determine, but a lot depends upon the company itself in terms of what they want to tell you, why they want to tell you that, and so forth. It's hard to generalize.
How do you generate investment ideas?
So, we're an opportunistic investment group. We look for things around the world. We will, I'm happy doing stuff in developing countries as well as developed countries. But there's a huge, I've been doing it for 15 years, 16 years, or more than that actually. You have an accumulated knowledge base of companies, really. Well, companies, people who've done what to people, so you know who to stay away from. You also have learned a lot about the sort of landscape in various countries. We probably looked at pretty much every company in New Zealand, most companies in Norway. I mean, that sort of stuff, we spend a lot of time looking at individual companies. So there's enormous body of accumulated knowledge in our group. I'll give you an example of that. For example, we looked at Brazil for a number of years. And maddeningly enough, it was just very difficult to find anything that was cheap and safe there for us. So we just did nothing. We did nothing in Brazil. We visit companies would visit us here. We'd learn about them, we'd put our notes into our database, and put them aside. Finally, after all these years of no results in Brazil, well, bad things happen, and have been happening in Brazil and many emerging markets. Suddenly, Brazilian stocks started to get cheap. And in fact, some of the companies that we thought were very interesting were among those companies. So we could move fairly rapidly on that. So what causes opportunities? So this is the aspect of being sort of aware and ready for opportunities. But what causes opportunities to happen? Well, there could be a few things. What gives us these chances? Well, it could be company-specific disaster. It could be an industry-wide bout of unpleasantness, downturn, cyclical depression in an industry. Or it could be an economy-wide or across economies. You could have some sort of capital market event that seems to be going on and on and on and on in Europe, providing different opportunities at different points, obviously. But so you have some degree of readiness, but your ability to respond should be there. Sometimes opportunities are fleeting. Sometimes you can have the luxury of time to build up your positions. But you have to have some degree of preparedness, some degree of knowledge, for example. I mean, for example, you could see, looking back a couple of years, the sense was Romania was going to hit a brick wall. There wasn't a whole lot there in terms of investable stuff. The odd thing was the crisis that ensued and the IMF's prescriptions has generated an ever-expanding list of potential securities. So from what was not even an investable place, there was not a whole lot to do there. There's a development. Or for example, so you keep your eyes on the world. You keep your eyes as to what's out there, what could be out there, what isn't out there today. But learn about it. You have to be a curious person. So I tell my colleagues, look, if you're not hungry today, looking around, you're definitely going to be hungry tomorrow. But you won't have captured your meal. So.
Now, do you, just in that context, do you use screens much?
No.
So
the problem is, there's a number of problems with screens. Everybody uses them. I'm usually the last person to get around to these things. Everybody uses screens for the same kinds of things: price to book, price to earnings, price to sales, price momentum, a whole bunch of similar kind of things. So I'm not sure I have any value added there. Third, screens tend to rely on historic accounting information. And historic and accounting. There's a gap oftentimes in accounting values and economic values. Now, what we're interested in is finding this gap. That's what we're interested in. For example, let me give you a very prosaic example, a very silly example. Zinc in the early 2000s was going through very bad, metal zinc, base metal. By the time we got our act together to look at zinc, it was 2004. And zinc was below the cost of production for about 55-60% of the world's producers, they're still producing. And many of them had written down their assets to nothing. For example, gigantic mines had been written down to nothing. But they had no accounting value, but they had economic value. Now, the screen would have captured a sort of premium price to book in a case of a mining company that had written down its accounting value, its value of the mine for accounting purposes. But lo and behold, 3 or 4 years later, when the zinc prices turned around, this mine kicked on, came on stream, and it was gushing cash. So screens can be misleading in that regard. So screens are very focused on accounting values. And there's yet a fourth reason why, which is a much more interesting reason from my perspective, because I like to look at industry structures and how they change. In the case of depressed industries, what happens is sometimes industry structures change. Consolidation can happen, closure of capacity can happen, market shares change. So the profitability of a company historically is absolutely no indication of what happens in the future. So industry structure change can sow the seeds for very, very different industry dynamics and profitability. Screens are completely useless for that sort of stuff. So there is that aspect to it. So there's a lot of things, softer facts, harder facts, that screens just don't capture. People like them, people are good with them. It's not a skill of mine.
Looking at your portfolio, what sticks out is some holding companies, agriculture investments, real estate. Where do you see the biggest inefficiencies? And I know it's all company specific, but are there any, for example, holding companies, is that a bit of a theme? Do you perhaps look for holding companies?
Not per se. However, it's been a fertile hunting ground. Holding companies come in just many different kinds of shapes and sizes and textures. I mean, let me sort of reject a few that are never going to be of interest to me. For example, again, holding companies all have their own histories, which would, to some degree, influences and determines their purpose. So, for example, a holding company that exists for the pure sole purpose of exerting control of another entity or collection of entities, for the sole purpose of that and nothing else, is of no interest to me. Example of that, I'm not saying it's a good or bad thing, is Peugeot's holding company, PSA. And it's always been a discount. I think Peugeot is not a brilliantly managed company, and it shows. And all you do is buy Peugeot shares, and the discount narrows, the discount widens, and whatever it is. I mean, that's of no interest to me. It's always a discount. So mechanically, it's a discount. Second, holding companies where there's control exerted, it's very important from my perspective to see the nature of control that's exerted. So, for example, during the early stages of the global financial crisis, 2008, when Europe was beginning to get hit in early mid-2008, we bought a Swedish holding company called Lundbergs, which we don't own anymore. Lundbergs is a family that controlled this collection of different investments, focused largely on real estate and financial services, and some of the metal bender, the standard Swedish industrial companies. Again, here was a situation where the family had A-B shares. There's two-class share structure. They control this company through the class of super voting shares. So you have to be super cautious there as to what their motivations are. How are they running the companies? And you have to be brutally honest with yourself and critical in terms of the nature of the engagement with each of these own holdings that they have and how they've added value over time. And to our mind, they've done a very, very good job. Hence, that Swedish holding company got into our portfolio because of that. For example, Handelsbanken. Handelsbanken, which is one of the banks over which they exert a certain degree of influence. Handelsbanken was the only Swedish bank which did not have to go through a recapitalization. All the other ones did, be it Nordea, Swedbank, and SEB, Svenska Banken, all of them. And the SEB is controlled by the Wallenberg family. So watchfulness in terms of control in a constructive way is an important thing. So that's another aspect. Are they adding value? Or are they using, that's very important. Third factor is, in terms of holding costs. What does it cost to run this business? We don't want yet another layer of cost. Oftentimes, holding companies are a very efficient way to own a cluster of assets which are managed cheaply. Think compared to a mutual fund, for example, and is it compelling? Is it 0.2% of assets that they manage, you can oversee? So that kind of stuff. So this is exerting yet another layer of cost? Ideally not. Fourth, what's of important to you, it should be, are the assets inside it cheap and are they interesting to own? So that's getting to the core of what it is you're really trying to do with owning a holding company. So you have cheap assets sitting inside. You have on top of that a further discount, holding company discount, reflecting, hopefully it's a big one, these are cheap, and hopefully it's a big discount to boot. And of course, therefore, you're getting a double sort of, if I think of it as a leveraged way of owning investments. So, those things go up in value, the NAV increases, and the discount shrinks. That's another aspect to it. Now, what I do not like is the mechanically looking at discounts. Okay, this is a 40% discount, therefore it's better than this 24% discount. The stuff that could be contained in the company at 40% discount could be expensive stuff. Whereas the one that is at a 24% discount could own severely depressed securities. So clearly, the one at 24%, so you do not blindly follow discounts. You want to have to own the stuff sitting inside it, and this is another layer of discount. Obviously, governance that you alluded to is a very important thing. It's very, very, very important. And also an important thing is in terms of thinking. I'd like you to think about what a corporate, you have to think, there are two sets of thoughts you have to think through. The underlying corporate entities, are they of interest to you? And the sort of overlay of the holder, the owner, the control party. Is their orientation aligned with yours? So are there communities of interest, or are they going to rip you off? Are they going to screw you? I mean, you have to worry about it. You worry about that at the level of the companies, you have to worry about that additionally at the level of the control parties. So the usual paranoia applies. And there's one last thing. So, and this is something really, really highlighted by the global financial crisis. So there's a collection of holding companies, and in those days, a number of them were in France, still are, that used to do sort of private equity type investing. And there's a bunch of those. I mean, there's all kinds of holding companies out there in this world. So the argument that they would lay out is, we're doing these buyouts, we own equity in these companies, which we control, we oversee them, and the leverage is at the operating company, and we upstairs, the holding company, have a clean balance sheet, or cashed up balance sheet. So we have no net debt, they would tell you that. So, all true, all factual, and the debt at the level of the operating company is non-recourse to the holding company. Also true, very good. And of course, the debt is at the operating company, so there's a matching of cash inflow and cash outflow to support the debt. All good. So what's wrong with this picture? Well, what's wrong with this picture is the following. You own these leverage companies. You, Mr. Holding Company, own the leverage companies, and the problem is the global financial crisis did some nasty stuff to some businesses. Leveraged businesses found they couldn't refinance stuff. Leveraged businesses found that they weren't making much money, and that made it even harder for them to service their debt. So effectively, what was non-recourse, the gun to the holding company's head was, if you don't stick in equity capital, you are going to lose all your equity in this business. So was it really non-recourse? Yes, in name it was non-recourse. Operation, it was very much recourse. So you have to separate the leveraging. So in general, we do not like A, leverage of the holding company, and B, we do not like a lot of leveraging down below either. We do not like too much leveraging going on down below either. So that is very important for us. So that's sort of how we think of holding companies.
Now, there's a lot of noise around Europe, and some would say there could be naturally some dislocations, inefficiencies there. How do you make sense of it? What opportunities do you see arising from this European crisis?
Europe has been an evolving opportunity set. At the early stages of the global financial crisis, 2008, early 9, you saw opportunities in Northern Europe. Two kinds of opportunities. You saw opportunities in some German financial institutions, insurance companies, not banks. You saw opportunities in manufacturing companies in Austria, in the holding company I mentioned earlier on in Sweden. Also saw opportunities in French operating manufacturing company. So that opportunity set existed. The Nordics effectively sidestepped the crisis, largely did. The stocks did brilliantly, and we're largely out of those stocks. In fact, they are out of those stocks. The opportunity set seems to have moved further south. So gingerly we've approached the south. The south being the exciting part of Europe, which is Italy, Spain, Portugal, Greece, all of those countries. So we made a first Italian investment in 2010, November. The company was the object of a takeover bid in early 2011, which is extremely irritating. It was very profitable. We thought we could have made a lot more money over time, compounding it over time. So of course we had to look for more ideas. Well, we own a Greek cement company, but before I get into the details of what we own is, think of what we're trying to do. We want to buy businesses cheaply that are going to be around for a while. So going back to the discussion about business models, about not needing recurring financing, you make the first important assumption is the capital markets are going to close down. You, company in Greece or company in Italy or company in Spain, are not going to have access because your bank's a bust. And nobody wants to write a check for a Spanish company or Italian company. So you should have the ability to survive on your own, okay? For a reasonable period of time, give it a year, 2 years, without having recourse to external financing. Because otherwise, you might be in this position that if you don't get your bank financing in place, you might have to engage in terribly dilutive equity financing, for example, because there's always somebody willing to write a check at a price. And if I'm your investor, I don't want to terribly dilutive financing to reduce the value of my holdings. So you've got to be able to survive the near term, assuming the closure of capital markets or sources of external finance. The second thing, which is very peculiar to the situation. Now, everybody threatens to throw everybody else out of the euro. So Germany's going to throw Greece out, Germany's going to throw Italy out and Spain out. I mean, there's sort of this angst-ridden drama that's unfolding. So, I said, fine. We saw Argentina unpeg itself. So we could assume the drachma unpeg itself from the euro, or the peseto unpeg itself, or the lira to unpeg itself. And yes, you will have this new currency. So you ask the question, now suppose the drachma would come back. Would our Greek cement company survive? Well, it was an obvious question for us to ask. Would we bought our Italian investor Parmalat? Would Parmalat survive if the lira came back? And the short answer was, of course it would. Well, Parmalat had two issues. It had 1.6 billion euros of cash and was making money around the world, excess cash. So capital markets are not an issue. Second, Parmalat was, yes, it was listed in Milan, traded in Italy. It was an Italian company nominally, but the Canadian business was bigger than the Italian business, the Australian business was bigger than the Italian business, and did stuff in the rest of the world. So Italy was a part of its business, but it was not a deal killer for us. So that's how Parmalat made sense to us. So what about a cement company in Greece? Well, we own the cement company in Greece because it is listed in Greece, but does a lot more outside Greece than it does inside Greece. And I suppose it could be a comforting fact at some point in the future, like it had been in years past, that Greece is a duopoly. It's a duopoly which has always been oversupplied with cement, and most of cement is exported. Because cement is exported, the reintroduction of a drachma, I suppose, is probably good for that company. But this company also has operations in Turkey, in Egypt, and many of the Balkan countries. It also is a reasonable sized player in southern Atlantic states in the United States. It's actually quite big in Florida. It's a big player in Florida. And maybe the Florida market will revive before the Greek market. Who knows? And it doesn't need financing. So that's how we own that. Now, the problem with buying in these markets, mechanically you can see cheapness. The problem is, how did the banks and how did everybody get so crazy in leverage? Well, the banks lent a lot. So companies borrowed a lot. And witness the stuff that's been going on. A lot of these companies in Spain went out and acquired stuff in Latin America. Witness Repsol's newest adventures, Repsol's adventures in Argentina, for example. Repsol's busy. Spanish companies have to look, oil companies have to look outside Spain for oil and oil resources. And they did, legitimately and reasonably. But so, of course, they went outside Spain. So finding companies that are cheap, meet our criteria in terms of, obviously, in terms of safety, Safety from a capital markets perspective, from a perspective of governance, and that's quite important. Most of these companies are controlled, and sometimes by highly leveraged owners above. So of course, the temptation is to do stuff which may or may not be good for you. For example, you can talk about Endesa. Endesa, big Spanish utility. Now the problem is, sitting on top of it is Enel, which owns 92% of Endesa. Enel is a highly leveraged Italian utility. So we know who's going to finance whom. So that's the sort of problem you've got to worry about. What are the owners like? What are their motivations? Will they strip cash out of you and leave you with nothing? I mean, there is. It's not as easy as it sounds.
When we look at your portfolio, however, currently you have little to no investments in companies headquartered in what's labeled as peripheral Europe. So is that a reflection of you just haven't found the opportunities yet, or is there more to it?
It's not been for lack of trying. I will say that. I will admit that. We do have something in Greece. We did have something in Italy, which was taken over. You may well see stuff there. So I will never say never in that regard. But it may look deceptively easy if you look at valuations. The numbers, valuation-wise, in some ways look cheap. Unfortunately, there are each of these companies comes with issues, be it balance sheet issues, be it currency mismatch issues, be it governance issues. There's always something that's been the deal breaker for us there. So I will not say no, that there won't be stuff in the future. You may see stuff in Italy and Spain in the future, prospectively. I will not forecast that. Again, we are usually out there responding to opportunities. We do have ideas. Pricing may not be right.
Let's move on to another market that a lot of value investors actually are shunning, but you've been there for some time and
Yes.
have large holdings in Japan.
Yes.
How do you approach Japan? What is different about your approach, and why do you see value in Japan, and then where do you see it in Japan?
Okay. Now, a couple of things. Japan, if you were focused on safe and cheap and forgot about everything else, your portfolio would have nothing but Japan in it. It is very, very cheap. Numerically, it's very cheap, and companies are often flush with cash. It is neglected, it's disliked. It meets many of these criteria that draw people, some would say suckers like us. There's a whole collection of value investors there, gnashing their teeth and wondering, what is it that we do and have done? First, before last year, before 2011, disproportionately, to my mind, value existed in the domestic companies. Disproportionately, by a big margin. Exporters are battle-hardened. Locally, Japanese companies have been cosseted and coddled, and the local companies tend to operate quite differently. So our focus was on domestic companies. They all met the safe and cheap criterion. Now, the question, of course, you ask is, after some years of requisite impatience and nothing happening, how are we going to make money here? That's the question everybody asks themselves. So having worried about the same question some years earlier, because over the years, you must understand, my history with Japan goes back to the early mid-1990s. And Japan has been a place where you invest, and you wait and wait and wait, and suddenly make money, lots of it, very fast. It's always been this whole hockey stick phenomenon. It's like watching paint dry. Now, this time may be different, I don't know, I can't tell you. But the way I've approached this was, look, you buy things, you put yourself in the path of some kind of change. Change which may come from the companies themselves doing right sorts of things. So these are we don't buy perfect companies. Let me be very clear about this. Are these great capital allocators? Often not. Let me give you an example of one of our holdings, which we have, which has done everything right except for one of the most important things. Mitsui Fudosan. Mitsui Fudosan is a magnificent real estate company, almost near trophy real estate. A great balance sheet, growing the top line rapidly. It's building. They're building buildings. They're doing all the right sorts of things. However, what's the rub? The rub is the following. You're building buildings there with cap rates of 5%, when you can repurchase your shares at high single digits like 9-10%. To my mind, it's not a very big leap of imagination that gets you there. Yet, for the last number of years they visited us here, for the last number of years we asked them, why do you not do that? They said, no, we have to grow the business. So the business is growing, will grow. It is cheap, and it may stay cheap for a while. How value is building. We are waiting for the lightning bolt to hit there.
So what do you say to people who, when you tell them about your approach to Japan, and then they say, well, yes, I get what you're saying, but how do you get over this corporate governance? It's
Please, you have terrible corporate governance in other places too. Japan is being, I think, singled out. Japan is being pushed into a crisis. They will change. They will change. I mean, Japan's response to tsunami and Fukushima was shockingly slow. You're actually seeing change, I think, flowing from that now. I'm a patient investor. Again, we don't have a huge amount in Japan. We don't have, and some people who are Japan sensitive say, well, why don't you have an index weighted? Again, we bought what we could buy, which was interesting to us. We are very patient. We are seeing industries reconfigure, restructure themselves. We are seeing them gradually eke out more and more and more. The response of Japanese companies has not been entirely irrational. For example, for companies to hang on to cash in a period of deflation is a very rational response. It's a logical safety blanket. Logical, completely logical, because it enhances the probabilities of survival. And they did that. They had very conservatively configured balance sheets to cope with this sort of deflationary spiral the country went through. They also worked hard on their costs. I mean, there's a lot of good that's gone on in the process. The arguments against Japan revolve around the lack of M&A market. Because if there was a very active M&A market, you would seriously start to see change happening in terms of valuations being recognized.
So this argument about corporate governance then, in your view, does not reflect the specific opportunities that often pose exceptions to that overall negative view.
Oh yeah, I mean, there's lots of reasons to be negative about Japan. Lots of reasons, heavens. I mean, the demographics, the slow responses to crises, silly economics. I think it's maybe silly economics. A lot of stuff that they could do. I mean, a lot of the damage is self-inflicted, quite clearly. There's all these broad, the lack of active M&A market. But by the same token, the steps are slow, baby steps, evolutionary steps. It is a culture not characterized by a lot of people who wish to be outliers in their conduct. Let me tell you yet another worry I have. Japanese companies increasingly being seized by the fear that Japan is so permanently ex-growth, given the fact that they're accumulating these cash balances, given the fact that there are fewer and fewer growth opportunities within Japan, will start making crazy acquisitions outside Japan at very high prices. That is, for me, a much more scary thing than the other ones you mentioned so far. That scares me. Because Japanese companies, historically, have not been the stingiest of acquirers. They have not been willing to engage in some, knock them out and drag them out, get a fight to save the last nickel. They just have not, they don't have it in them. They prefer to be viewed as friendly takeovers. Sometimes they're expensive takeovers, unfortunately.
Now, some people would also say that, if they can get over the corporate governance, then often what's cited is, but it's bad demographics and the economy. And how do you, perhaps realizing that doesn't present a hurdle for you, how does that perhaps filter down to the selection of the specific companies? So I'm thinking, are there any themes in terms of more export-oriented companies, more certain sectors, or how does that enter, if at all?
Well, the hurdle of dealing with Japan is overcome by looking at 2 times earnings for companies. I'd rather pay 2 times earnings for companies. Insurance companies, I used to certainly love the idea of owning insurance companies at fractions of book value, fractions of embedded value, as opposed to buying those at multiples and multiples of book value in China, because China had growth, this had no growth. So I mean, that's one hurdle. I have a much bigger hurdle to deal with in the case of these growth markets, or at least once growth markets. They are repricing too, as they should. I wouldn't say export companies have particularly been a theme for us, no. The most recent purchase of ours, actually 2 of them, we bought Daiwa Securities, which was largely domestic. In fact, unlike Nomura, they have somewhat smaller global ambitions, so they're not going to do silly things like buy Lehman Brothers and then find out that everybody runs away after they buy them and stuff like that, all that stuff. They're much more local, they're much more focused on things like asset management business locally. That gives me source of comfort. So companies that have really narrowed their focus, where they are very good and very big players, is of some interest to us. A company we bought, Otsuka. Otsuka trades a very, very modest multiple of operating earnings, which it has grown over the years. This is a company which is like a systems integrator. It's a company which is kind of like Ingram Micro in the US, for example. They're very big, and Japan has been a sort of slow innovator in terms of its installed computer base. It's much slower. They're very good at what they do. It's a company which was set up by a Rico copier repair guy who basically got into these and saw this huge opportunity to help sort of automate, modernize small and medium enterprises in Japan, which were very, very slow. And they've actually been growing very rapidly at the expense of the mom and pops. And even in this horrible market, they've been growing rapidly. I mean, the surprise, I think, what will and should and probably will surprise people more is the rate of earnings growth happening in Japan. That's not what we focused on. We focused on cheapness, bought our stocks, and what happens. I mean, I'm incapable of forecasting the future. But
what is the single biggest mistake that keeps investors from reaching their goals?
Straying from the discipline, believing that they're smarter than they are. So, there's a number of things. I mean, one, it depends on what kind of investor you are. I mean, let's talk about investing as opposed to the business of investing. Okay, I mean, there are different kinds of things. The difference of determinants of success. There are overlaps, but there are things specific to the business, there are specific things to the actual act of investing. Each of us, again, we all come with our package of beliefs. We all come with our intellectual constraints. We all come with our history. That conditions how we think. That conditions situations that we are better adapted to analyze, think about, constructively, creatively. Overreaching beyond that is a dangerous thing. Some people, sometimes, in the belief that they know more than they do. I mean, some people have a mistaken belief in numbers. Numbers, there's an exaggerated precision in numbers, as opposed to what causes the numbers. And one of the things Marty always says, forget what the numbers are. What do they say? What's behind those numbers? So people could take numbers too literally, or people could overreach in other ways. Overreach in terms of somehow people take on levels of risk that they probably shouldn't, in expectations of greater glory, and of course they have their heads handed to them as a result. Do what you know, and be very, very risk averse. Because there's new ways of losing money being invented every day. Try to avoid being one of those people. I mean, it's so easy to do.
How do you improve your investment process over time? Specifically, your judgment of investments. Have you tweaked anything as a result of the crisis? Some value investors will say that they have tweaked something because of the more emphasis on the macro. What about you?
Well, my first watershed event in investing was the Asian crisis. That's when I started investing, was in '96. last quarter of 96 was the first quarter. Then 97 went headlong into the Asian crisis. The operating principles have always been the same. The whole focus on survivability. I mean, safe and cheap has taken you through the Asian crisis. So, I mean, the learning that happened then, even before the Asian crisis, because I'd spent a number of years working with Marty by that point in time. So the focus on survivability has always been a very big part, because when I started here, we went headlong into in 1990 there was a big financial crisis, which was when Drexel Burnham blew up, the high yield debt market blew up, a number of life insurance companies were going to blow. In fact, the entire life insurance sector was going to go. In fact, property casualty companies got in trouble because this precipitated commercial real estate crisis, which also insurance companies had. So there were multiples of interlocking financial things. That was the beginning of my investment education was here. So going off on my own in the way of investing, I go headlong to the Asian crisis. So, okay, we have our own crisis to deal with now. So it was actually very simple. You just avoid companies which have, the valuations you'll be presented with in those sort of periods is so ridiculously stupid. Companies are just swimming in cash, no reason to borrow, and you get an operating business for free. Now that sounds good. You could do that. I could live with that. And of course, those companies were multi-bankers after that. But importantly, though, what particularly colored me was how capital markets can close down. It didn't really happen in 1990. The high yield debt market sort of imploded and closed down. But here, the visual experience of watching people line up to pull their money out of Thai finance companies in 1998 July is a rich experience. It's one that sort of continues. So if you're a company looking to run your business, and arguably in those days, nobody really thought that would ever happen there. And of course, a lot of people got flat-footed. So that tells you what you have to do and what you don't have to do. You don't want to be in companies that need to borrow to keep their business going forward or access capital markets. So that's always been a cornerstone. Second, the other thing about that financial crisis, the other learning aspect, which is also true for subsequent such events, is you can buy stuff very cheap and gets cheaper. So you buy things slowly. You value very conservative, value for worst case scenarios, and then start your buying. And assume that it's going to get cheaper. When people are in the middle of this mad panic, value has nothing to do with them. They just want to extract the cash and separate themselves from that piece of paper that keeps going down the next tick. And so of course I'm there buying it, and it goes down the next tick anyway, so I keep buying some more. I mean, look, a favorite example of mine was a Japanese securities brokerage company I was buying during the heat and goings on in those days. There's a few of these things. The stock had a book value of 750 yen per share. I started buying at 265, completely clean balance sheet, had never lost money. Again, this is 98, the Japanese bear market began in 1990. And it's always been odds and ends of money. And the stock had declined, and I thought, 265, I'm brilliant, I'm buying this thing. And I bought a little bit, it went down, I bought a little bit more, it went down. It got to 145. And I thought, Lord, I'm mad if somebody else is mad, so I bought some more. And then the company said they announced a buyback of 10% of the company outside. I said, that's good, put a floor under the stock. And they bought back 10% in one trade that day. And the thing went to 120. I said, this is pretty scary stuff. So that was August 1998. And about a year later, the thing had gone to 800 something yen per share. I was beside myself, exultant, sold my shares, they went to 1,700 after that. So merely that, brace yourself for terrible things to happen. I mean, but, obviously all the while making sure that this company has survivability. And the company is still around today. It's still very much around today. So, and very much a survivor. So, I mean, that was the second, so not a whole lot of tweaking has happened. Survivability has always been a part of it. But the important thing also has been to look for, so be very careful of situations where something that's cheap on an individual company level, where you're buying conservatively, and then you get steamrolled by the macro. There's no predicting that, and there will be no predicting that. But the way to defend yourself, at least partially against that, is the internal solvency and the viability of the business in the absence of capital markets, and as well as being very, very, very conservative in your valuations. That is very important. It's paramount. Being a very, very stingy person in terms of valuing securities has protected us so much against so many adverse developments. It has not eliminated the fact that things, when you start buying at 265, go to 120, but it reduces the pain relative to buying them at 700. So, I mean.
Now, you have the benefit of working alongside one of the investment greats, Marty Whitman. For those of us who don't have that opportunity, what are some of the resources, some of the books that you would recommend to young people starting out, to anybody who's really interested in improving their investment acumen?
A few things. Look, my path was the following. I encountered Marty's first book in 1979 when it was published, and I lucked into encountering Marty's work in the early 80s and wound up working with him in the 90s and thereafter. It was very lucky. Clearly it was very lucky. And equally I'll say I was lucky to have survived it. Marty's a taskmaster. He's brilliant, but he doesn't suffer fools. Now, value investing is a much broader discipline than Third Avenue's approach to value. It is important that anybody who goes down this path, be aware of a few things. Know yourself. There are certain kinds of things that value investors do which are not fun. Fun in terms of patience, fun in terms of due diligence. This is grunt work, this is hard work. It's very unglamorous. I would tell you, growth investors have a far more glamorous life. They're the sort of fun end of the business. Their companies are always growing, it always looks good, they have high ROEs, it's always wonderful. We're at the other end of the spectrum. We do the unpleasant stuff. We deal with these terrible companies, terrible countries, companies facing difficulties, companies which may need to be recapitalized. There's all sorts of stuff. So know what you want to do. Value investing may or may not be for you. So that's item number one. But even if notwithstanding that you really think value investing is for you, there's a lot of stuff that's been written about value. Books that come to mind. Again, this is in no particular order. Obviously, Marty's first book, his original copy of The Aggressive Conservative Investor, was to me a great book. As I said before, and I will say without being bashful, the book's a damn turgid read. It's a deadly read, but it's a very bright book. It's full of a lot of ideas. Then, of course, there are the other books that he's written, namely Value Investing, A Balanced Approach. Those who get you going. And then, of course, there's Seth Klarman's book, The Margin of Safety, which also came out, I believe, was in the early 80s, if I recall. Seth's book was a fabulous book. It's a great book. It's a much more user-friendly book. So there is that. Then, of course, if you enjoy special situation investing, there's Joel Greenblatt's book. His book is Anybody Can Be a Stock Market Genius or something of that sort. It's got a very odd title. It's actually a very bright book. I think it's a very clever book. Again, I'm not a fan of mechanical investment formulae. If that's what you do, Joel has another book about that, which then there's most recently this Howard Marks's book. Howard Marks is a great writer. The book is a very nice, breezy summary of what we do, what he does. There's no question. Much of it, there's lots of wisdom encapsulated in Howard Marks's book, which is, I think, a really worthy read. One may want to read Howard Marks's book before going off the deep end and doing Marty's book, for example, to reconsider. But importantly, so if you really if you made it through all that stuff and you actually read Graham and Dodd's Fat Book, you really want to pursue it. The only way to do it is by doing it. Doing it is, I believe, a process of some degree of apprenticeship, with somebody who is going to actually teach you. There's no sort, because you can learn generalities. There's an art of recognizing these things. There's an art of not being freaked out by these things, these options when they stare you in the face. There's an art of recognizing things that are sometimes very subtle, things that could hurt you. And that's very important. You can only learn that by doing. And you do it by ideally working with an experienced person. I mean, it's obviously easier said than done. Find the right person who's actually looking for somebody with the right temperament to be a mentor, but that's probably the way to do it. I mean, there's a lot you can do by yourself, and some of my personal values about investing and investments were formed before I came to work at Third Avenue. In part, they were based upon the books that I read. And, you know, obviously I read Seth's book well before I came here, Graham and Dodd, Benjamin Graham's Intelligent Investor, as well as Marty's first book. So a lot of that was done. Read, for example, letters written by investors. I think I would commend to you, obviously, the Berkshire letters. Obviously, they're must read. I would commend to you the letters written by the folks at Lucadia. I think they are absolutely brilliant investors. I'd love to become like them when I grow up. If there's anybody I want to grow up to be, it's like Cummings and Steinberg. Certainly the letters of Third Avenue funds. I mean, I realize it's a plug, so you know I'm not an objective party. But the letters, we talk about a lot in the letters. We talk about the stuff that moves us, stuff that causes us to invest in things. The letters are a serious source of education. At Third Avenue, we are some old guys, are mentors to the young people. One of the things our younger colleagues have told us is a big part of the learning experience is not just Marty's book, but also the letters. So we would certainly commend you the letters. I quote what they say. I would find it difficult to be able to bear reading those letters that we've written yet again. But I think they are apparently quite educational. They capture a moment in time as to how we've invested in a specific investment and what we are thinking. So that's one way to do it.
That note, Amit, thank you so much for your time and all the insights you've shared with us.